The Minsky moment is defined as a sharp drop in asset values that signals the end of a market cycle's growth phase. On the surface, it's a dull, bland finance concept coined in 1998 by Pimco's Paul McCulley to describe the Russian financial crisis. But before you dismiss this video as a textbook economics lesson, consider this. The Minsky moment could very well become the defining term of our generation and our country, a phrase that could be used to describe the modern American economy. In today's video, we examine whether this is truly where we're headed and whether this term accurately describes our current economy. So, a Minsky moment occurs after a long period of consistent prosperity and gains, a period of time that distorts risk perception, which results promote extreme leverage and forces investors to use borrowed money rather than cash for what can only be described as sophisticated gambling. Look around and you'll notice that many of the characteristics associated with Minsky moments are present in our economy. Since 2009, the S&P 500 has increased by over 500%, with only a few brief dips. That's one hell of a growth. The U.S. Federal Reserve, which enacted a policy of 0% interest and extreme quantitative easing in order to essentially cure this country of recessions and depressions, made this period of affluence and unlimited gains possible. We currently have a Federal Reserve that is out of ammunition, unable to lower interest rates any further, and politically unable to print more money. Meanwhile, the Consumer Price Index, or inflation, has just hit a 40-year high. Jerome Powell is pleading for a gentle landing, and the coming months will be very crucial. On CNBC, Mohamed ElErian recently made some jaw-dropping remarks about Fed policy and why he believes they may have lost the narrative with investors who believe that the Fed is panicking. The Fed must complete 3 tasks with utmost priority in a short period of time. Number 1, they have to regain control of the inflation narrative that is spreading around in the market. Number 2, they have to regain control of the policy narrative. They have to give the people some sort of hint of what the soft landing looks like. And lastly, number 3, they have to show the people a lot more humility. Following the Great Depression, there were strict laws restricting how much money could be borrowed to buy and sell securities. Big banks and institutions have created hundreds, if not thousands of loopholes to get around these rules over time through lobbying and other means. Instead of cash, these banks use securities. They make large bets, and when they lose, instead of calling margin, they borrow billions of dollars and use it to buy up the asset, driving its price up too and preventing losses. The strategy is doomed, as black will appear 10 times in a row one day, and the line of credit will dry up, leaving you with massive losses. Warren Buffett and Charlie Munger have been warning everyone about this practice on Wall Street for years now. They sat down for an exclusive interview in 2020 and discussed the dangers of leverage and how it dominates today's markets. They said that the people who profit from this irrational credit extension argue in favor of it, and no one speaks out against it. According to them, we got the correct regulation on margin debt the last time around, which came and stayed for a long time, but that was only because of the worst depression we had in the history of the world. That's what it took to make the politicians see sense, a depression. When the journalist questioned that there have been suggestions that there should be more transparency and that allowing people to lever up like this should be prohibited, and what were their views on this, to this Warren Buffett simply said that the good answer was never to allow this kind of stuff to start, and now it's getting very tough to be regulated. But returning to the Minsky moment, we have had a long period of euphoric growth and a massive amount of borrowed money speculation. Market crash prediction is a near impossible task that requires more luck than skill. Many well-known investors such as Michael Burry and Jeremy Grantham have criticized the markets and predicted a market crash. They've been wrong for over a year, and while the dangerous parameters they're referring to are indeed flashing red, the stock market can stay irrational for longer than you can stay solvent. Thanks for watching this video. We hope you enjoyed it. Please make sure you hit the like and subscribe buttons. See you in our next video.